Okay, thanks a lot for joining us. We're just getting settled in for our next town hall. I appreciate as you come in, making sure that you remain on mute for now. And if your video accidentally comes on, just to save our bandwidth, would you please turn it off? Feel free to wave though as you go by. It's nice to see everyone. Of ISBM, the Institute for the Study of Business Markets. And you have joined us at one of our Marketing in Uncertain Times town halls. We've been hosting these town halls since March, since craziness has happened and unpredictability has taken over our lives. So we appreciate you joining us. We've been trying to provide you programming that is comforting, perhaps, useful, and now in these days when we're starting to look forward to going out more with fear or anxiety or excitement, whatever you have, we're trying to prepare ourselves with information. So we're really, really grateful you joined us today. I'm just talking for a few minutes as I see more people piling in before I get into how does Zoom work. So again, thank you all for joining us at ISBM. So let's talk a little bit, and I'll spend a few minutes hoping to catch most of you. If you've not been in a Zoom meeting in the last 6 weeks, well, great for you. Most of us have been spending our lives on these. But let me tell you about some features if you haven't had a chance to use them. So if you hover over your screen, depending on how you've selected to set up your desktop, you'll find that bar, right? There's a bar there that has all of this information. So if you would please remain in mute, that's that little line across the microphone, and remain with your video off, which just saves us bandwidth. And then you'll see these other things that are across there. One is you can see other participants, but there's an important one called chat. If at any time you'd like to ask a question, particularly when one of the speakers is speaking, just type your question into the chat window, or you can type in the chat window to me, my name's Lynn Yanyo, that you'd like to ask the question out loud, and we'll be happy to do that. Another way to let us know that is that you can raise your hand. So if you're looking in your window and you see raise your hand, you can do that. And then over in the participant window, we can see that you raised your hand and we will call on you. The raise hand icon doesn't go away after you've asked your question. So we might have to remind you to put your hand down, which sounds terrible if you're in the classroom, but this is, please lower your hand and then you're fine. So those are your two ways of interacting with us when you're wanting to ask a question. We're also going to have some polls, which means if you're at your phone or at your computer doing this, that you're going to click on a particular answer in the poll and support us with providing your information and data. So that'll be really helpful for us as we ask you some questions during this period, and you can see what other people are thinking as well. Okay, so it is 3 minutes in. We've got 70% of the folks are in that has registered, so I'm going to call that good. And if you have questions about how to use anything, feel free to send a note to us in the chat window. Okay, our moderator for today is Rand Mendez, and those of you that are ISBM members, of course, know Rand because Rand is their membership director and he's talking to you all the time, and feel free to talk to him at any moment when you need help. And Rand has buddies everywhere, and one of them is Robert Fry. And so we're really, really grateful to have Robert join us with all of his knowledge base. And Rand, I'm going to turn it over to you now, and I'll be on mute, but in the background.
Okay, thanks, Lynn. And there were a few people who said they were having trouble getting audio. If there is somebody, please raise their hand and Lynn will take care of you. Hello, everybody. Very heartfelt welcome, especially to our ISBM members, friends of ISBM, and a special hello to many old friends that I see have registered and are attending today's town hall. It's great to see you here. I'm very pleased to introduce Robert Fry to all of you. Robert is one of the leading corporate economists of our time. He has guided DuPont, its customers and suppliers for many, many years until he retired in 2015. He's been recognized with many awards, including from Bloomberg, USA Today, the Wall Street Journal. Robert received his master's and his PhD in economics from Harvard University, so he knows what he's doing. He has been recently named a fellow of the National Association of Business Economists, and that's quite an honor. Being a fellow, he joins 4 other Nobel laureates and the last 4 chairs of the Federal Reserve. Today, Robert continues his work of translating economic conditions into useful information for his corporate clients. And he issues a monthly newsletter. The title of the monthly newsletter is Current Economic Conditions. I think it's a very aptly titled newsletter because it's so simple. And that's what I always remembered about Robert, is he really took the complex and translated it in simple ways for business leaders to understand what was going on and how they could use it in their business planning. Robert, we're very anxious to get your insights today about the current economy and what's ahead of us. So let's get on with it.
All right. Thanks, Rand. I appreciate the opportunity to speak to you all today. I'm going to give you my view of the global economy, although I should point out this is mostly US. It's more US focused than my normal presentation. And that's because most of the rest of the world has a longer publication lag with their data. So the data that we have for most of the world only goes through February. And given the way the world has changed so much this year, February data is essentially ancient history. So it doesn't do us much good. So I'm going to concentrate on the US and a few other countries for which we have up-to-date data. Before I dive in, I should point out 2 things on this title page. One is my URL address, robertfryeconomics.com. You can find out more about me and my company there. You can also subscribe to my newsletter. And I'm running a special there. If you go to the subscription special page, you can get the last 8 issues for 2020 for the price of 6 issues, essentially. Also, you see my email address there. If you'd like a copy of my slides or a copy of my April newsletter, just email me at that address. Of course, let's see, there we go. Start out with a disclaimer. This essentially says economic forecasts are sometimes wrong. So this should not be considered investment advice. I will do my best, but you should not call your broker while you're watching this presentation. That's probably not a good idea. I like to start by explaining the role of a business economist. This is something my late mother found on the internet many years ago. It was very embarrassing that my mother was actually on the internet before I was. And this is the punchline. So my job as a business economist over the years has basically been to tell people with great views where they are. But before I talk about where we are, I want to talk about where we were as recently as February 19th of this year. As of February, the most recent GDP data we had was 4th quarter of 2019. And we had growth at a 2.1% annual rate, which is the same as we had in the previous quarter. And it's basically what we had done for a 5-quarter period after we had this 5-quarter burst of 3.1% growth after the 2016 election. So we went from 2.1% from the 2010 to 2016 period up to 3.1 for 5 quarters and then fell back to 2.1. There's a lot of disagreement about why we fell back to 2.1. President Trump blamed the Fed. The Fed probably raised rates too much in 2018. The December 2018 rate cut was pretty obviously unjustified. The ones before that made sense to me at the time. In retrospect, maybe the Fed shouldn't have gone so far. So housing came off in 2018 and early 2019 because of the higher interest rates. Now, most free trade, free market Republicans, but also a lot of Democrats, the free trade Bill Clinton Democrats, would argue the economy slowed back down because of the tariffs. And if you look at data on new orders for non-defense capital goods ex-aircraft, which is the monthly data series that economists use as the proxy for quarterly investment in equipment, it slowed right after the tariffs went into effect. So there's some considerable support for the argument it was the tariffs that slowed things down. There was another argument that's popular mostly with Democratic economists like Larry Summers, but also some apolitical economists like those of the Congressional Budget Office. And that's that the potential growth rate of the US economy is about 2%, maybe a little less. And the tax cuts maybe gave us this temporary sugar high, but it wasn't going to last anyway. And so growth was going to slow back down to 2.1%, and that's what it did. There's a less political explanation for why the US economy slowed. That's because the rest of the world was slowing for things that really had little to do with what was happening in the US, other than the fact we passed a tax reform law that was designed to bring business back to the US. And we shouldn't really be surprised that some business came back to the US, and that resulted in a slowing of growth in the rest of the world. But there were some self-inflicted wounds as well. Brexit in Europe, I think some bad economic policies in China. So the rest of the world was slowing, that slowed us down. Employment growth, the first 2 months of this year, payroll employment, 273,000 net new jobs in both January and February. To put that in context, we only need 100,000 jobs, plus or minus 25,000, to absorb all the growth in the adult population. So 273,000 was unsustainably strong. So it actually looked like the economy was picking up as 2020 began. Unemployment was at a 50-year low of 3.5%. Manufacturing, which had declined from December 2018 through the first half of 2019, wasn't really charging back, but it was stabilizing. It wasn't going down further either. Oil production was at an all-time high, and stock prices hit their all-time high on February 19th. And then the black swan arrived. If you've read the book by Nassim Nicholas Taleb, he talks about unexpected or unexpectable events. He actually says this wasn't a black swan, that we should have known that a pandemic was coming, but we couldn't know when it was coming. We couldn't know what the exact virus or flu was going to be, so we couldn't produce a vaccine in advance. So I think this qualifies as a black swan, and it has shown up in the data. It first showed up in initial claims for unemployment insurance. This is the best weekly measure we have of the US economy. The first week of March, claims were at 211,000, which was pretty close to an all-time low. They jumped up the second week to 280-some thousand, still low by historical standards. And then the next week, they jumped up to, I think it was 3+ million, and then eventually got up to 6.8 million in a week. The previous high before March of this year was 695,000 in a week. So at its peak, it was 9 times the previous all-time high. And even though it's come down in past weeks, it's still around 3.8 million as of last week's number. We'll get additional data tomorrow. So it's coming down, but we're still adding several million to the ranks of the unemployed each week. The second piece of data that we got that showed the impacts of COVID-19 was motor vehicle sales. And they were running at about a 16.8 million seasonally adjusted annual rate in January and February. They dropped to, I think, 11.4 or something like that in March, and then down to a little more than 8 million in April. So this has plummeted quite rapidly. People don't want to go test drive a car, and they don't want to make big ticket purchases while their economic circumstances are uncertain. And if you look at this statistically, econometrically, the most important determinant of vehicle sales is job growth. People get a job, they need a way to get to work, they have to buy a car. If they're not going to work, they're probably not buying cars. And so we've seen vehicle sales plummet. We also saw the biggest 1-month decline in retail sales in March since the data series began in 1992. Interestingly enough, though, if you look at the breakdown for retail sales and look at grocery stores and general merchandise stores, which include Costco and Sam's Club, they had the biggest 1-month increase ever in March, and pretty much every other category had the biggest 1-month decrease, and they overwhelmed the winners, and you see a big decline in March. And we're going to see another decline in April when we get data. Industrial production had the biggest decline since early 1946 during the demobilization after World War II, down more than 6%, and that's month to month, not an annualized rate. I show it 2 ways here. The headline number is in black. I prefer to look at manufacturing. The headline number, total industrial production, includes mining and utilities. And utilities really tells us more about the weather than it tells us about the economy. The reason the black line has been rising faster than the red line until the last month or two is because oil and gas production are in mining, and they were at record highs as of a few months ago. But that's going to change right now because oil prices have plummeted in reaction to the reduction in oil demand around the world. So we've seen a big decline in oil prices. And because of that, we've seen a decline in oil drilling. The rig count has been plummeting lately. Some drillers are still drilling because they have contracts that they have to satisfy. But as those wells are completed, they're not going to start new wells at current prices. And this is production. As I said, we were at record levels as of, I think, February for crude oil and last November for natural gas. We've probably hit the peaks for a while. Those are going to come down over the rest of this year. And the stock price index plummeted 34% from its peak in February to a bottom in March. It's since regained about half of those declines. And real GDP, we have first quarter real GDP. It was down 4.8% at an annual rate. That was worse than all but 1 quarter in the Great Recession. So this was the worst decline since fourth quarter of 2008. And year-over-year growth has dropped almost to 0. And this is just the beginning. We'll talk later about where this may be headed in the second quarter. So this is where we stand today. Large segments of the US economy have been shut down. Travel and entertainment especially have been shut down. We started to see a little bit of opening, but still large segments shut down. Stock prices, as I said, fell back 34%. We had a huge jump in claims. You see all the bad news, all of which I've covered so far. The possible good news is the last item there. The Fed and Congress and the president have responded with the economic stimulus at an unprecedented speed. We've never seen them act so quickly. So hopefully that will help going forward. So this shows what the Fed has done. They had cut interest rates 3 times last year, but they've cut interest rates twice this year by a total of 1.25%. So we're down pretty much against that 0 lower bound. They're holding the federal funds rate, the overnight rate that the Fed targets, between 0 and 1/4 point. They've also purchased assets, including corporate bonds, municipal bonds, mortgage-backed securities, and the regular old treasury bills that they are always buying at an unprecedented rate. So the Fed's balance sheet has increased quite rapidly. And then on the fiscal side, we've had These three bills, you know, a little one, a medium-sized one, and a huge one. And because there wasn't enough money for the Paycheck Protection Program in the CARES Act, there's been a supplemental one after that. I haven't added that to this page because it makes the font get so small that you can't read it. But you know, they have allocated more funds for the Paycheck Protection Program. We can talk maybe later about some contradictions here between whether you want people to stay home from work or whether you want them to go back to work. And there are, you know, some contradictory aims among some of these plans. But you know, when you want to get something passed in a bipartisan manner, sometimes bipartisanship means I vote for your bad idea if you vote for my bad idea. So there's a little bit of that, but in this case, they decided on fast instead of perfect. So this is what we know. We have put the economy essentially into an induced coma. The original reason for that was to flatten the curve on the number of infections so that the hospitals were able to accommodate everybody who needed hospitalization so they weren't inundated. Since then, you know, even in places where the hospitals weren't filled or weren't inundated, there's been some pressure to keep things shut down. And different states are taking different approaches here, whether to stay shut down or to open up. The April declines that we're going to see in employment, that'll come out Friday, retail sales, industrial production next week, they will be the biggest ever. I'm pretty certain of that. Unemployment, which we will get Friday morning, will soar to the highest level since the Great Depression. The second quarter decline in GDP will be the biggest ever, and that's since quarterly data began in 1947. We're going to see a rapid but incomplete snapback when the shutdowns end. That's going to look big in percentage terms by the law of small numbers, that if you start from a low enough base, everything seems to look big in percentage terms. But just keep in mind, if you fall, say 50% and then rise 50%, you don't get back to where you started. You still end up 25% down from where you started. So just because we have big numbers on the upside does not mean we get back to where we started anytime soon. So annual growth this year will be the worst since 1946 during the demobilization from World War II. So what we don't know exactly when the economy will hit bottom. It may have hit bottom in April, which would make this the shortest recession ever, with a business cycle peak in February and a business cycle trough in April. Normally, a recession requires duration, depth, and dispersion, and it's not clear this has enough duration to qualify, but I think the National Bureau of Economic Research is going to call this a recession, even if it ends up being only 2 months long from peak to trough. Another question is, will there be further shutdowns and a new bottom after the second quarter? You could have a case where the economy opens up, people go back to work, economic growth is positive in the third quarter, but then you get a surge of infections and businesses shut down again, and you get a negative fourth quarter, which takes us to a new low. So we could hit a new bottom. We're now treating this as different from a typical recession because the cause is different, and we think that if we remove the cause, say through a vaccine, that we're going to get a quick rebound. But you know, recessionary psychologies and damage get built into the economy, so this could become more like a typical recession even after the cause is removed. Now, what will the recovery look like? Typically, economists look at recessions and recoveries and the shape of those in terms of various letters. A typical recession is a very symmetrical V. You come out of it about as fast as you went into it. If you linger on the bottom for a while before you recover, it's a U. If you get a double dip, which you could get if you have to shut down the economy again, that's a W. There's always the threat of the dreaded L, where you never recover. Fortunately, that's never happened to the overall economy, although that could happen to individual businesses. They drop down and never come back. There's the Nike swoosh, which was a popular way of describing the last recession and recovery, where we had a pretty steep decline in 2008 and 2009, and then a very slow recovery after that. You could also have stair steps. You could have the initial bounce where when businesses are opened up, and then people still stay away from stores and restaurants and flying and cruising. And so the economy just sort of staggers along until you get a vaccine, and then people go back to something more resembling normal. So you get that second step of the recovery. So those are the various steps or shapes that I can think of. When do we return to normal? I think that probably is the same as asking when we have an effective vaccine, because I'm not sure we can get back to normal without an effective vaccine. Normally, in a recession, manufacturing, say industrial production and manufacturing, declines much more than GDP. And consumer spending declines much less than GDP, especially spending on services and non-durable goods. Well, this time, the service sector of the economy is feeling much of the brunt of the shutdowns, things like restaurants and travel and entertainment. And so manufacturing may not be hit so much more than GDP, as much more than GDP as it normally is, because services are feeling a lot of the pain. We also don't know how many businesses will go bankrupt. The government's trying to prevent that. Now, technically, bankruptcy does not mean you cease operations. It just is a change in ownership, but it's probably a bit too much to hope that you could have mass bankruptcies without businesses actually ceasing operations and causing economic damage. So the number of bankruptcies is very important.
Hey, Robert.
Yeah.
Can you go back to that slide, because we've gotten a few questions, and some of them relate to some of the points you're trying to make here.
Okay.
So, let's start with the possible impact of a second outbreak on the economy. And you mentioned that could look like a W.
Yeah.
Where we're recovering, then there's another outlook and it goes down and then it comes back again. But is it that simple, or is there other dynamics that would come into play if would we all of a sudden become a lot more cautious for the next recovery if we have a second outbreak? Do you have any thoughts on that?
Yeah. If you get the second outbreak, the recovery after that might not be as strong as the one that we're going to get initially. So you sort of do a W that's trending down until you get the vaccine. So you could have several ripples. In the Spanish flu, you had basically three big waves, and the middle wave was the strongest of the three. So this would argue that if we get hit badly in the fall, the fourth quarter of this year could set a bottom. And then the first quarter might be a weak recovery, but nothing too strong until we get the vaccine.
And then one other related question to this slide is, I think we now all understand that there was key fundamental differences in what started this recession. But coming out of it, is it going to be typical? And I'm speaking specifically to the manufacturing sector now, was the question. Will there be any implications for industrial markets different than there were for the 2008-2009 crisis that we had?
Yeah. Other than industrial production might not underperform GDP as much as it does in the normal recession. I think a lot of it will be typical because what's going to happen is manufacturers will pull in their horns. The people that buy from them will sort of stop accumulating inventories. And so you get this, what's called an inventory bullwhip effect, where the farther up the supply chain you get, the bigger the impact is, because inventories are drawn down at every step down the supply chain from you. All the way down the supply chain, inventories are drawn down. So the guy at the top of the supply chain, the raw material supplier, gets hurt the worst. That's probably still going to happen. So, you know, we're still going to have big inventory swings, which is why the manufacturing sector and the goods sector more generally usually gets hit more during a recession. If you go back to the 1950s, an inventory cycle in and of itself could cause a recession. The goods sector of the economy is not as big as it was back then. So that probably can't cause a recession by itself, but it certainly can cause big swings within the manufacturing sector.
Okay, thank you. And then one more question, as you mentioned, the when will it return? It will return with an effective vaccine. A question just came in. Any thoughts around an effective treatment that lowers the severity of the illness or the death rate of the illness? Could that have a similar effect as a vaccine?
Yeah, that could have something, because right now people, especially if you're in a vulnerable demographic group, you're afraid of dying from this. So you're going to stay home. If you get an effective treatment, even if you know you're going to get sick, if you know that takes away the risk of dying, you're probably going to be more likely to go out into the world and
thank you.
Something like normal activity. Yeah, you probably want me to put some numbers to my forecast, so I guess I should do that. But this is a quote that you may have seen before. I've been using it for years. It is often misattributed to Yogi Berra. I think most clever quotations are misattributed to Yogi Berra at some point, and if not Yogi Berra, Mark Twain. But I worked at a science-based company for 30 years, and I actually had the pleasure of working with some physicists, so I thought I should get the attribution to this quote correct. This was actually said by Niels Bohr, the quantum physicist who won the Nobel Prize in Physics in 1922, but it also applies to economics. But even though it's difficult, I have to put some numbers down. I'm on a lot of survey panels, so have to put in something. I have a 40% decline in the second quarter. I actually had a 50% decline until I revised the forecast in the last week. Before you freak out and think that means the economy is going to decline by 40% this quarter, that's not what this means. This is expressed at an annualized rate, which means it assumes that whatever decline we get this quarter is going to be continued for 3 more quarters after that, and that would get you down 40%. What this works out to is about a 12% quarter-to-quarter decline. And you can think about that's a quarter of the economy shut down for a month and a half. That would be about 12%, 12.5%. Or a third of the economy shut down for a little more than a month. That would get us this kind of magnitude. So it's a big number in annualized terms, but that does not mean that economic activity declines by 40%. The flip side is you get a good third quarter, so I've got it bouncing back at a 20% seasonally adjusted annual rate. And then we stay elevated in terms of annualized growth rates for a while, to gradually get the economy back to normal. Now, what I was saying about annualized rates and how that makes this number look bigger than it really is, you've probably seen this quote lately. It's been used, it's been applied to the spread of the virus itself, but it also applies to the math of annualizing quarterly growth rates and making them look much bigger than they really are, which is what's happening right now. So I think maybe the best way to look at GDP is not as a quarterly growth rate, but as just a level of GDP. This is real, meaning inflation adjusted gross domestic product in the US. So a very steep drop, a quick rebound, and then a slower rebound. And then if we get a vaccine, say the middle of next year, then a little pickup late next year, and we gradually get back to something close to the previous trend. Now, this was Monday's forecast. Yesterday, there was some talk that Pfizer and its German partner is already working on a vaccine, already testing a vaccine. If we get more good news on the vaccine, I will put in a faster recovery than what I've got now. But this is my forecast, the forecast I put together Monday.
Robert, another question there on that forecast is, as we've seen in the past, unemployment doesn't move in lockstep with GDP growth. And now some fundamental changes are happening too, to the way we work and so forth. So the question that's come in is, where do we see unemployment going over those quarters where we have a huge drop? You already told us we're going to see depression level unemployment, but then we're going to see several quarters of seemingly huge annualized growth rate. What do we see with unemployment relative to that?
I see it getting into the high teens as early as the number for April that comes out on Friday. What makes it hard to forecast unemployment and what makes the headline unemployment rate misleading is that if somebody has not looked for a job within the last month, they don't count as unemployed in the unemployment rate. So you can have a huge drop in the number of people who are working, but you could have a similar drop in the size of the labor force because they didn't look for work, so they don't count as unemployed. So the regular headline unemployment rate, which is called U3 by the Bureau of Labor Statistics, is going to understate the increase in unemployment. So you should look at the U6 unemployment rate, sometimes called the underemployment rate, and it counts people who have not looked for a job within the last month, but who have looked for a job or were working within the last year. So those people are going to be counted as unemployed in U6. So U6 is going to show a much bigger increase in unemployment. Some people think that's a more valid measure anyway, because it also includes people who are working part-time, who would like to work full-time. It's including those as being unemployed. So look at the U6 rate when it comes out on Friday. It will probably show a much bigger increase. I think unemployment probably gets down to around 10% by the end of the year, first quarter of next year. That's what I've got. That's a little bit slower than what James Bullard, the president of the Federal Reserve Bank of St. Louis, said yesterday in a webinar he did with my professional association. He said a 10% maybe by the end of the year.
Okay, so we go maybe if with this GDP growth through the end of the year, we still may be at 10% unemployment by the end of the year.
Yeah.
And is that there's a question about meaning, is that cumulative unemployment, or is that what you're saying in the U6 unemployment?
That's U3 unemployment. That's just the percentage of the labor force that's not working this month. And if you're not looking for a job, you don't count as being in the labor force. So, I'm expecting a pretty sizable drop in the size of the labor force because people aren't looking. It's going to be interesting for the Bureau of Labor Statistics. They asked 5 supplemental questions which made you some clarification. So if you look at the report on Friday, look at the special questions. I don't have a lot on the rest of the world, but China does report data with a fairly short publication lag. The red line is their official measure of industrial production. I think that's artificially smooth and maybe a little too optimistic. I prefer the black line, which is I take 100 industrial products for which they report physical production and take the median year-over-year growth rate. And you'll notice that's lower than the official number. And so that plummeted. January and February, the 2 months are reported together. That's when China felt the brunt of this. They have some bounce back in March, but still below prior year levels. This has not shown up in industrial production for Europe yet. That's the red line. But the black line is the IFO Manufacturing Business Climate Index, and that leads industrial production, and it's pointing to some big declines in February and March and April. So that red line is going to plummet in coming months. This is my forecast for the world. I don't do this on a purchasing power parity basis. So it's not directly comparable to the IMF numbers. They're at, I think, -3.5 or -3.2 on a purchasing power parity basis. I'd probably be -4 or so on that basis. But a big drop, more than twice the size of the decline in the worst year of the Great Recession.
And Robert, how do you explain the North America being the worst of the each of them?
Yeah, I probably need to update this slide a little bit because I don't think I have my most recent forecast in there. Yeah, North America should be more like -6.5, and the world should be -4.8 now. That's a good point. I forgot to hit right click and update the link. So if somebody sends me a request for the charts, I will make sure I've updated the number because the world is now -4.8 and North America is a smaller decline, and maybe some of the others are slightly bigger than that. Good catch. You'll notice some of those numbers had numbers to the right of the decimal. Economists use numbers to the right of the decimal to show we have a sense of humor. I've used that quotation for years. I just found out last year where it came from. It was the American novelist William Gilmore Simms, and he grew that beard to show that he had a sense of humor. Given all the uncertainty right now, I think rather than depending upon a point forecast, whether it's mine or someone else's or a consensus forecast, I think you need to consider different scenarios, how this might play out. A methodology I learned when I was at DuPont from an outfit called Global Business Network involved putting together a 2x2 matrix. In this case, I've got the size of the decline on the vertical axis and the speed of the recovery on the horizontal axis. You could pick something like the length of the decline and the speed of the recovery, or just two dimensions that make sense, and then you come up with the 2x2 matrix, and then you sort of fill out the story that goes with each. How you would get that kind of scenario. In this case, I put some probabilities in, although I think I might be, that changes as new data come out every day. So maybe I shouldn't have put that in. One of the things that Global Business Network would teach you was at least one of the scenarios should seem totally impossible to you, because historically, sometimes it's the impossible scenario that turns out to be the one closest to the truth. But so I've fleshed out some things. Mostly when I forecast, I'm looking at leading indicators, the economic indicators. This time around, I think you have to look at medical things, because this is not going to, the course of the economy is not going to be determined so much by interest rates or government spending as it is whether and when we get first an effective vaccine, or I mean effective treatment, and second an effective vaccine. And given what we're seeing in the last week or two, we might have the effective vaccine before we come up with an effective treatment, because none of the treatments have helped that much. Remdesivir, they talked about it. It was significant. It was significant in the statistical sense, meaning how confident they were that it actually helped outcomes. It was not significant in terms of magnitude. It was very minor improvements in fatality rates. It cut hospitalizations from 15 days to 11. But Pfizer's news on a vaccine may be bigger news than any of this. And if we're going to get that upper right quadrant, that's going to require a vaccine pretty quickly. So this is just an exercise you could do on your own. We could talk about this some more later, or you could call me and talk about this.
So Robert, we want to do a poll now.
Yeah.
And but before we do the poll, we saw your GDP forecast.
Yeah.
And which of these weightings do you want to say relate to that forecast? Is it threading a needle, or is it?
Yeah, that's sort of been my forecast is somewhere between the bottom right and the upper left. My old forecast was very much bottom right. I sort of slowed down the recovery, and instead of being down 50% in the second quarter, I'm down 40%. So I moved a little bit from the lower left-hand quadrant to the lower right-hand to the upper left.
Okay.
Either of those gives you a very similar cumulative loss of GDP below what your trend was. It's just a different path. Whereas the upper right is definitely much better, and the lower left is definitely much worse.
Okay, so Lori, let's do a poll on how the audience feels about Robert's forecast from their own perspective.
Wondering if we have to take down Robert's slides to put up Lori's poll.
Now, let's see.
Lori.
I'm seeing it.
All right, there you go. All right.
So it looks like most people have voted, and most people have read Robert's bio and realize that he is an expert forecaster. So they're agreeing with him being on target. And then as far as all the others, a little bit of outweighing of the too optimistic over the too pessimistic. So, okay, thank you. Interesting.
So
Did everybody see that? Were they shared?
Yeah, I need to go back to share screen, I guess.
Yes.
Okay, good.
And while I was offline, I actually updated this slide. So you'll notice I now have North America, a smaller decline in Western Europe. So I hit update link. So that's where we are there.
Okay, that was really bothering you, wasn't it, Robert? You have to
Yeah. So people think I'm too optimistic. I should point out that of all the forecasters in the consensus economics panel, I was the most pessimistic forecaster last month. So, so that says something when people think that the most pessimistic forecaster is too optimistic. Yeah, I hope I'm wrong, but I hope I'm wrong in the other direction. These are just some ways of identifying what scenario we're in. I think one of the important things is some states have opened up If we don't see a big rebound in cases and deaths, that's a good sign, and that maybe the economy is going to rebound more rapidly than we expect. If the rebound in cases and deaths is so bad that we have to shut down again, that's a very negative sign. So that's stuff we need to look at. Need to look at bankruptcies. Yeah. Let me quickly go through here. To get an idea of what the economy is going to do, I look at leading indicators. These are some of the usual suspects. I especially like interest rates and housing indicators. Here, one thing to look at is to make sure that black line is below the red line. If it's above the red line, that's an inverted yield curve. That tends to indicate recession. So in this case, maybe a higher bond yield is a good thing, not a bad thing. And the Fed's not going to raise interest rates anytime soon because inflation is well below its 2% target, and it's likely to go further below before it goes above. The most important indicator in the monthly housing report is single-family building permits, and you'll notice it plummeted in March. Watch that. When that turns around, that's a really good sign. This is a very reliable leading indicator. In the past, low oil prices were good for the economy. Then we became the largest oil producer in the world. So it's not clear that that's true anymore. So this is not the positive news that it once was. And the one leading indicator that actually said we were going to have a recession and was right this time was heavy truck sales. And you'll notice it's plummeted even before we got hit by COVID-19. So truck buyers might have known something that the rest of us didn't. I have a leading indicator model that I use to forecast industrial production in manufacturing. It was pointing to negative growth, but the actual is much worse than the forecast because this is being driven by things that are not normal economic indicators. So this was not anticipated very well.
Robert, we had another question that was
Yeah.
related to your prior comment around bankruptcies and cease of operations, I think. But the question was in the 2000 in the 9/11 impact to the economy, and again in 2008 and 2009, we saw, while most companies were rushing out, we saw a few companies rush in and take advantage of buying opportunities. What are you sensing? What are you hearing about that in regards to companies that are flush with cash?
Yeah, it's funny. I turned to my key takeaways here, and about the fourth one down is that most companies should forget about earnings and focus on survival. And then I added in parentheses, or scavenging. Companies that have strong balance sheets that resisted this pressure to do leveraged recapitalizations and go out and borrow a bunch of money to buy back shares. If they're sitting there with a strong balance sheet, they're going to be able to buy assets on the cheap. There will be companies going bankrupt or companies trying to avoid bankruptcy by selling off assets or certain businesses. And companies that are in good shape financially are going to be able to buy those assets on very favorable terms. I'm not sure there's a whole lot you can do now, but if you happen, I mean, in terms to prepare for this, you either have a good, strong balance sheet or you don't. But if you're in that first bucket and you do have a strong balance sheet, you should have a shopping list and an idea of what you're willing to pay for things, and you might be able to take advantage of a once in a lifetime opportunity to buy things at a very good price.
Okay. And does that relate? Do you have any special insight to that in the housing market? Apparently, some of the participants are concerned about housing prices, and whether now's the time to buy or should they be selling, et cetera. So, is there any special impact there?
The stuff I've seen so far, and the people that were actually compiling these surveys, the data from surveys, was that prices have remained very firm. They have not softened yet, which is kind of surprising. So if you were
Okay.
thinking of selling, maybe it's a good time to sell. But my opinion of housing is that you should never look at it as an investment. You should look at it as a place to provide a place that you'd be happy living in.
Yeah. Okay.
If you want an investment, you're much better off buying stocks. Much better off buying stocks than buying housing. So do that. I want to conclude just with some key takeaways here. As I said, this will be the worst quarter ever. Economic policies, I hope will reduce the human costs and maybe reduce bankruptcies. But they can't stop this from being a really bad quarter. The short-term economic hit is going to be bad. I mentioned earlier some of the policies are contradictory. We have enhanced unemployment insurance, an extra $600 a week added to benefits. And so some companies that are actually doing well because of the shutdowns, say Amazon or some grocery stores that are trying to hire, they can't get people because they're paid and they're essentially getting $35 an hour to stay home in some states like Massachusetts. So they can't get workers. At the same time, you've got the purchasing or the paycheck protection program that makes the loans forgivable if they maintain their workforce, if they don't lay people off. Well, if they've laid them off and they hire them back, they can still get forgiveness, but they're going to have to pay a lot to hire them back, or the employee would prefer to stay home. Now, of course, if you're called back and you refuse, then you lose unemployment insurance. But how happy a worker are you going to be if you're called back to work and your income goes down because your regular pay is less than the enhanced unemployment benefits? So these two things work at cross purposes, and that was not very well thought out by our legislators when they put this together. As I said earlier, the strength of the recovery depends more on medical breakthroughs than on economics. One thing to keep in mind, the way economists define a recession, it is just the period when economic activity is shrinking. So it ends when you hit bottom. If you're an unemployed person or a business, someone managing a business, you're basically in the recession until you get back to the pre-recession peak. So to most people, the recession lasts a lot longer than it does to an economist.
Robert, there's a couple key points here. So what we're going to do is we're going to continue for anybody who can stay on, who wants to stay on for a few minutes longer. But before we do that, we do want to wrap up a couple things for those who have to leave. First of all, I wanted to mention that you will be able to see this presentation on a replay link, which we will send out and will be on our website, isbm.com. We will also be reaching out to you in regards to interest in receiving Robert's newsletter, monthly newsletter for you and for people in your firm through now and the rest of the year. It's only a few $100s, a very affordable investment for how useful the information could be. And we have a couple polls we have. The first one up is who might be interested in hearing more about this newsletter offer. We'll let that play out for a second. And again, we're going to continue on. We'll take about a 10-second pause for anybody who has to beep out, so the beeps can all leave. And then we'll continue on with the points Robert's making on this presentation.
Hey, Rand, this is Lynn. I'm just going to break in that we missed some people on the first poll, maybe because we needed you to go down to your control screen and click on polling so you could see the poll and then make your choices, right? So just make sure your poll is showing so that you can vote. So we'll give you a little more time. All right, Lori, you got it back.
Okay.
You ready for me to wrap up, Rand?
No, you're good. We're gonna continue. We just have to get these polls in. So we got some good feedback on your offer, and then just some final feedback on this town hall.
And so I'll add on this town hall poll that we really, really appreciate your feedback. We've been doing these on the fly. I wouldn't even say that there was a whole lot of available time to really prepare well for all the things we're doing. And so we're grateful for the incredible experts that we have that can pull this off with very little timing ahead of time. But we'd love to make these better. So even after this poll, if you'll just email us or go to contact us on isbm.com and give us your insights or ideas for improvement, we'd really appreciate it.
Okay, so now we will continue on, but of course, we did officially end this at 2:30, so we will not be offended for people who have to sign out. I'm sorry, Robert, you can go back to your points on this slide because we do have quite a few questions that are still queued up.
Yeah, I'm just going to make one more point here. I'm a public finance economist by training. I took public finance in graduate school from Marty Feldstein, and who was sort of the mentor for most of the great public finance economists of my generation from both parties. And it was interesting. I was at a professional association conference in February, and we had Jason Furman, who was an economist in the Obama administration, and he was a Marty Feldstein student, and Douglas Holtz-Eakin, who was a Republican economist, whose doctoral dissertation advisor was a Marty Feldstein student. And they agreed that the corporate tax system should allow immediate expensing of all investment, but should not allow an interest deduction, which to a public finance economist, is sort of, that's what we believe. We're taught that interest expenses, should not be tax deductible. And you look back at the problems we've had in the last 3 recessions. We had a tech bubble in 2000. I think that probably had something to do with margin interest being deductible. We had a housing bubble in 2005 and 2006 that led to the global financial crisis and the worst recession in 75 years until this one. And I think that was fueled by the mortgage interest deduction. And then now we have excess corporate debt, which is going to magnify the size of the current crisis. And we got that because corporate interest is tax deductible. And so you had activist investors and equity analysts and investment bankers telling companies you should borrow money and then deduct the interest and buy back stocks and look what kind of mess that got us into. So I'm hoping that when this is all over that we'll reconsider the interest deduction. We need to raise taxes somehow to pay for the huge deficits we're running up, and that would be one of the least harmful ways to raise tax revenue would be to get rid of interest deductions. I'm not holding my breath. Economists have been arguing this for at least 40 years since I first started taking public finance, and we still haven't changed the policy. But I'll get off my soapbox and stop there, and I guess entertain questions the rest of the time.
Okay, thanks, Robert. So here's another question. This one's from Joanne Smith, one of your longtime colleagues at DuPont.
Hi, Joanne.
Hey, Robert.
She's asking about what industries should we be looking at as early indicators, and what are we seeing, or maybe it's too early, but and as you look at different business-to-business industries, can you see some that are obviously going to be much worse than others?
Yeah. Housing is the one I would look to as the leading indicator, and then things that make stuff that go into housing, like building materials, carpeting, paints, stuff like that. Housing is still going down, but there's been maybe a little pickup in traffic according to home builders. And so maybe the decline is not going to be quite as deep as we thought. So I would look to the housing complex and things related to that for early signs. As far as business to business, in terms, it's probably similar to other recoveries from a business to business standpoint, or other recessions from a business to business standpoint. The big difference this time is more on the consumer end, especially services.
Yeah.
When I was speaking earlier about the inventory bullwhip effect, that's what's going to affect the business to business stuff, especially raw materials and intermediate goods.
Okay. Okay. And there's been a few questions about the potential impact from Chinese and Indian low price competitors and on U.S. companies who try to manage well, try to price properly and so forth. And yet, the impact in China and India, how big is that going to spill over here or into the global markets?
Yeah, well, at least right now, this seems to be a deflationary shock, at least in the short run, which means supply is demand is dropping faster than supply. We'll see how long that lasts, because the Fed is injecting so much liquidity that you would think maybe in the long run that could be inflationary. But we've got certainly the current quarter or so where there's going to be tremendous downward pressure on prices, and companies may have to lower prices to maintain competitiveness, or appeal to patriotism and maybe more rationally the need to adjust supply chains and diversify supply chains. It was clear from the tariffs that we were too dependent upon China, and now it's clear again from the early disruptions in Chinese productions due to the pandemic that we're too dependent on China.
Okay.
I think they need to start diversifying supply chains.
Yeah. So to those who are asking that question, you may want to contact us. We have quite a few functional experts on those topics. Another question is, this is in regards to the forecast of things recovering in a V-shaped, and maybe by 2022 kind of being back to where we were. But then the question says, oh, how's that going to happen with their belief that we fundamentally are changing how we're working, how we're traveling, and it may not ever recover back into commercial real estate, into airline travel, and that kind of thing.
Yeah, I was actually, before we got on, was jotting down comments about adjustment and reallocation, and the speed of the recovery is going to depend upon how quickly we do this adjustment. So we're going from the switch from brick and mortar to buying online is accelerating. How quickly can the online sellers increase their capacity so that the total amount of commerce stays similar, even though it's shifting from one to the other? I think there's going to be a lot less new commercial construction. We're not going to need any malls for a while. We knew we had excess square footage. That's going to become obvious. So there's going to be excess square footage. We're not going to need as many offices. My wife is an attorney, and she's been working from home for the last month and a half, and was talking to some of her colleagues last night, and they all think they're more productive working from home. That's not always true for people that may lack the motivation to work hard, but when you're billing by the hour like a lawyer does, you have the incentive to work hard. And if you're not driving a half an hour each way to work, that's an hour more you can bill clients. So the lawyers like it. that means there's less demand for office buildings. There will be some offset because not every house has a nice office in it. And my house has, basically an office and a sunroom that doubles as an office. But other people don't, and they're going to need renovations. You're also going to need renovations in office buildings that are going to stay open, because this open space concept that people have gone to because it saves money because you don't have to build walls. People might not like that anymore. They might not want to be around people breathing. So you might need to build some walls and build some offices. So, there's the adjustments there. There will be retail workers and waitresses that may be out of work, but they might be able to get work as delivery people, or, right now somebody from Instacart is at Costco shopping for my food. So there's, that's going to make up for some of the losses. So we'll see how the adjustments are. I don't think they're perfect in my forecast. It looks like it gets back to the old trend, but if you put a ruler on there and extrapolated the old trend, which was a pretty anemic trend by historical standards, you'll notice I don't get quite back up to it. So.
Oh, that's right. Okay. So you catch to where we are, but we lose a couple years of that trend line.
Yeah, we'll eventually get back to a new high, but I don't know if we get back to the old trend. There may be some permanent damage from this that will take a big change in the economy or a technological breakthrough to get
Okay.
it.
Do you have any specific view on long-term impact on the renewables market?
Yeah, I don't know. The demand for renewables will go down with the demand for fossil fuels. But, since oil is so cheap that from a dollar standpoint, people will only switch now because they're required to, not because renewables are cheaper. So this sort of sets the switch back several years until demand picks up. And
okay,
if you're in favor of a carbon tax, and that's not just a left-wing idea. There's Republicans who write op-eds in the Wall Street Journal, like George Shultz, the former Treasury Secretary, who have been advocating a carbon tax with all the revenue rebated back to individuals. If you're going to do it, this is the time to do it when oil prices are low. So you're not going to cause an oil price shock on top of whatever else is wrong with the economy. So, you're much better off doing that when oil prices are low than when they're high.
Okay, Robert. Well, I think let's see. A lot of thanks for the information. There's a question about access to talent. As we've had a long-term talent issue in the U.S., how can we could access to talent extend the downturn? That may, and is this going to help that situation? Is this going to buy us some time, I guess?
Yeah, it buys us a little time because we don't need immigrants as much as we needed them before, but in a sense, this is going to stop the flow of high talent immigration. What I thought the questioner was getting at was a conversation that I had with Joe Murray at DuPont years and years ago. He was my boss. He was really more like the wise old uncle in the corner office. But we were talking about how companies pull in their horns during a recession. They don't do capital expenditures. They don't hire. And really, that's the time when you should be doing it, because the iron and steel that you build plants with is cheaper. So you're better off doing that. Labor is cheaper. And he said, and you can hire the guys from MIT that normally you can't get, but because nobody else is hiring, you can get the really, the best MIT scientists. keep that in mind. You know, there's probably some really good college graduates coming out this year that don't have a lot of job offers. So you might be able to get some really good people.
Yeah, that's an excellent point, especially for this audience. So thanks a lot, Robert. We really appreciate your insights, your time that you put into preparing for this, and your generous offer of your newsletter. For everybody that ends this, and again, we will send out the link, and you can visit for the link on isbm.com.
Thank you very much.